how businesses can fight against the high interest rates and inflation rate, PSI arrangements, and the 7 income elements of a reinvested dividend. Hello and welcome to another episode of the Solve to Evolve podcast. The purpose of our podcast is to give our insights to help you, the individuals, the taxpayers, investors and business owners navigate your way through what's going on in Australia today. And so we've a pretty busy month, but I guess how are you guys going?
I'm good. I'll go first, Blocks. I'm going well. You brought the sign today, the Solve to Evolve sign. So we're improving every month and looking forward to today's podcast.
Yeah, excellent.
Yeah, I'm really well. Thanks, Phil. Looking forward to another episode.
And we're here again at the Snug Bar. I think it's nice and snug and we're pretty much going to call it home.
Yeah, it's a great.
So thank you to Rebecca for letting us in here. It's a nice local pub and we want everyone to come down and have a beer with us here.
Down here at Gymea in the shopping strip, down in the beautiful...
Great location. Sutherland Shire. Beautiful.
God's country. It's beautiful.
Pub. Come on down.
What more do you want?
So there's quite a lot happening in Australia today and today we just wanted to cover a few talking points. So the first one is how businesses can fight against the high interest rates and inflation rate, PSI arrangements, and the 7 income elements of a reinvested dividend.
Yeah, thanks, Phil. So we've been operating probably for the best part, say about the last 12 to 18 months in a pretty high inflationary and a high interest rate environment. And there's been a lot of talk, Phil, about how that is affecting mortgage holders and the pending mortgage cliff that we're about to all fall off together. But how is that high inflation and high interest rate environment affecting business clients and businesses that you're generally aware of?
Yeah, thanks, Chris. There's obviously been a lot of talks about how the high interest rates and inflationary rates are affecting families, but what's not being talked about a lot is the businesses. And so when you think about cash is like oxygen. And if it disappears in a few minutes, it'll end. You know, that was from Warren Buffett. And so right now, inflation and interest rates are eating away at your cash reserve. Interest rates have seen consumer confidence dip. And so during these uncertain times, people are not spending money, they're holding onto the cash reserve. And businesses have definitely seen a reduction in sales. And that's got to do with the fact that, one, yes, the consumer confidence is low, but also they're just sitting on their cash and thinking about, you know, whether or not they should make that purchase or not. So the the acquisition to make a sale now is obviously taking a lot longer. So interest rate rises have seen consumer confidence and spending down due to the uncertain times. And this has led to businesses' sales dipping quite dramatically. And it's also taking a lot longer for those businesses to convert those sales. Now, inflation is definitely, and I'm sure all business owners, and we've seen that as well, but our costs and businesses' costs have gone up. Some businesses may also be under pressure to increase wages to attract and keep staff members that they need. And that's really important right now because as we've seen over the last few years, it's changed from an employer's market to an employee's market. So the employees now are in the driver's seat. It's tough for businesses out there at this point in time, but I guess we just got to put our heads down and pray for the best.
Apart from that, Phil, what are some of the strategies and ideas to fight this inflationary environment for business?
Yeah, so what businesses can do during these times. So the first one, of course, is cost cutting. So reviewing your expenses in detail to think about, okay, what have I spent here? Was that necessary? And then look to budget for the next 12 months to ensure that you are controlling your costs. You know, you can also contact your suppliers and speak to them about renegotiating some of the costs, such as insurances, internet, any utilities, effectively, that's within the business. Another thing that businesses should look at doing is reviewing the pricing and margins, because that's the quickest way to improve your margins and your bottom line. So some businesses, I know, they will do work, they will provide a service, they will provide a good, but you know that price won't change over time. But right now, it's probably the best time to increase your prices. And the best way to do it is to, when you do work out how much to increase your service or your good by, the price of the service and good, it's always good to check how much or what that does to your bottom line, and also to clearly communicate that to your customers. They're in the same situation as yourself, so they will totally understand what's going on and the reason behind your increase. The third thing is to look at outsourcing or technological innovation. So because there's not a lot of talent right now across all industries, it would be wise for business owners to look overseas for outsourced staff. It is at a cheaper rate, and we've seen staff members from overseas work quite hard within businesses. And so that's obviously a good option. Implementing different technological systems such as AI or ChatGPT, things like that, to automate some of your back office or some of the processes within your business, just to save money. The fourth thing is, if your business is in or has a financial arrangement, a loan, a business loan, look at restructuring. So speak to a broker and look at how you can get a better rate and shop around. Now, the fifth one is to make smart use of your free cash. So if you're a family-owned business and you've got a mortgage, you're probably, over time, every month, you're putting away for tax, $1,000, whatever it may be, and you're saving that until the BAS is due, and then you make the payment. But
within the business, right?
Yeah, that's correct. So you might have your everyday account, you might have a savings account, and every month you're putting $1,000 away, whatever it may be. That's not a smart way of using your cash if you're a family-owned business and you've got a mortgage as well. Most people will have a mortgage with an offset account. So it'd be wise to transfer the money out of the business into your offset account, keep it there to offset any interest charges, and then when the time comes to pay the tax debt, then make the payment. And that's making smart use of your free cash. Now, doing all the above is great, but if you make these changes now in July, August, early on in the financial year, you're not going to see the results until maybe year end, when you sit down with your accountant, your advisor, and they do your financial statements, and they go, okay, you're still in a loss position, or you didn't make much profit as you should have. And so what business owners should look at doing is a freeway cash flow forecast. And so that's forecasting the next 12 months in terms of what your balance sheet looks like, what your profit and loss looks like, and your cash flow. So that's going to allow you to see any bottlenecks over the next 12 months of cash flow, and then you can react accordingly. But all those 5 things, if you're making those changes and you can actually forecast those changes out over the next 12 months, you're going to get a good idea of what profit you're going to be operating at, but also how much cash you have each month. And so that's what businesses can do to fight high interest rate and inflation.
So a lot of the things that you've said, Phil, really it speaks to me that you need to, as a business owner, really have a good handle on your financial statements. So be aware of how much revenue you're generating, which is a direct reflection of what your sales prices are, what the margin is, how much free cash you've got. So I guess my question is how should business owners get on top of their financial statements, and what do you do with some of your clients to make sure that the business owner clients are spending enough time to understand their financial statements so that they can do things like manage cash flow properly?
Yeah, good question. So business owners should just focus on running the business. It is important that they understand the financial position of the business, and it's always best to speak to their advisor, their accountant, to work out what their business looks like financially. Have an understanding of it, but you don't need to really go into the detail. The main focus of the business owner should be to make those sales and generate more revenue to the business. And at that point in time, and what business owners don't understand actually is, if you can make a slight tweak in your revenue by increasing it, or a slight tweak in your expenses by reducing some of that, they don't understand the impact of the bottom line. If you can change 5% in your revenue by acquiring more customers or increasing the price on all your customers, that's just going to be a massive benefit for them. And so my advice is to definitely seek out an accountant, your accountant, an advisor, and talk about putting a 12-month 3-way cash flow forecast together. to give you insight as to what your business looks like so you can make those important financial decisions for your business.
And when you say three-way cash flow forecast, what are the three ways that you're referring to?
Well, the three ways, the three financial statements, which is the profit and loss statement, which gives you an idea of what your revenue you're bringing in,
Right.
the expenses going out, your profit. The balance sheet itself is the financial position of the business, your assets, your liabilities, so your net assets overall. Are you improving each year, each month? And the cash flow statement to see how much cash is actually coming in, because obviously the profit and loss statement has non-cash items. So it's not a true indication of what your cash balance is, but the cash flow statement will give you that.
And you said about pricing decisions. How do you help your clients make those decisions? Is that part of the forecasting?
Yeah, correct. So it's going to be very beneficial for business owners that are more stable in terms of they've got stable income coming through. It's easier for them to predict. So whether you're providing a service or whether you're selling a good, you're able to then work out how they're currently selling and at what price, and what we can do if we increase the price of that good, or if we add a different service, or if we package it a certain way. Or we can look at, okay, your pricing is what it is right now. You can see that that's clearly under market. If we look at what your pricing is compared to your competitors, so there's a good chance for them to, or good opportunity for them to increase their revenue at that point without sort of scaring their customers away, because when their customers then look elsewhere, they can see that they're on par with their competitors.
Yep.
So Phil, what would you say to a business owner client who might be watching this at home and thinking to themselves, we're in a recession now. I don't want to increase my prices because it might drive customers away.
Yeah, good question. It's a tough one as well to answer. Look, I think that would really depend on the type of business that you're operating. Now, if you're operating a business where accountants, for example, everyone needs an accountant. As long as you are increasing your prices and being transparent to your customers about why you're increasing it, and confident that the service that you are providing them is of value and you can portray that value to the client, then you should back yourself and make the change. Because ultimately, though, you are running a business and the bottom line is yours, and everyone's going through a recession and so are you. And so you need to make sure that you're also taking care of your own and your family. So obviously be diligent about it. You're not going to increase the price by a big margin, but something that's logical, that makes sense, something that you can portray to your customers as to why this is why you've increased it. We've grown in size. We've got a lot of more costs in our business that we need to cover for, plus the inflation. But also, this is what we're providing to you right now, and this is how much value we've delivered to you. All we're asking is for a slight increase in price, whatever it may be. So that's how I would answer that question. Jono, there's a general trend in the marketplace of employees becoming contractors. People are starting new businesses and maybe structuring themselves. Now, I've seen that quite a lot as well. Can you both speak to what's causing this push? Who's benefiting from this arrangement? I'm seeing employees now getting pushed out. They're changing the arrangement to be a contractor for the same employer. Who's benefiting from this, and why is this happening?
Phil, I think part of it, at least from the employee side, is them wanting more flexibility, and maybe that's working from home, working remotely, and there might be that's on the employee side as to why they would value that, maybe that contracting relationship, which is a bit more independent rather than being under an employee arrangement. From an employer's perspective, I think there is a tight labour market, difficulty in getting staff. By going for contractors, they can open up the talent pool a bit and maybe chop up some of the roles that they have and get creative with their resourcing. So I think there's benefits for both sides, and that's probably what's pushing it.
What about you, Bloxy? What do you think about all this?
So I've seen a fair bit of it myself, Phil, and what I would say is that in some circumstances, it's the employer wanting to, in some cases, not have to meet as many obligations in engaging an employee, so wanting to change the characterization of the relationship. In those circumstances, it is dangerous for an employee to change the structure in which they're getting paid just because the employer wants them to. So I think an important point for employees who are stepping into contractor land to understand is that administration costs are quite high and structural complexity leads to more cost. So people should be aware that really a company or a discretionary trading trust is an entity for people who want to run a genuine business through it rather than to continue to act as a common law employee. Now, that's certainly not in every circumstance. There are benefits, as John, as you alluded to before, but it's important that people who are stepping out also look at the costs and the risks, not just the benefits of engaging in a contractor arrangement rather than a standard PAYG employee arrangement.
Yeah, that's right. It's a good point because I guess what employees or those individuals making a switch from employee to contractor sometimes don't understand of the tax implications that may impact them. So, Jono, if an individual is making that switch, what should they be aware of?
There's a few things they need to be aware of. First, I think, when do they cross that line from becoming an employee versus a contractor? They should have some idea about that. And it's usually at the point where, an employee will be someone who's subject to the employer. They're exclusively working with that employer, whereas a contractor won't have that restriction. So they're more independent. So firstly, you should have an idea about that. And the number one issue that I see for a lot of my clients, which a lot are in the technology and IT industry, is PSI or personal services income. So PSI is really income that is related to your personal skills, your personal effort, and the work you do. So it doesn't matter say if I'm contracting through a company and providing my personal skills, that income's going to be taxed to me anyway. I can't retain that in the company. I can't distribute it via a trust to my family members or do anything.
Because a misconception with most individuals is that if I'm going to go contractor, I can set up a company and just get the same income coming in, but get taxed at 25% versus at my individual tax rate.
Yeah, that's
But obviously,
right.
if PSI rules apply, that's not the case.
Yes.
Now you've set up a company for no reason, incurring all those compliance costs.
Yep, 100%. And I've seen that a lot and clients have come to me with a structure set up, and then we have to actually look at their arrangement. Is it PSI, first of all? And second of all, is it a business? So really the way to get out of those PSI rules, which you want to try and steer clear of them, is to be a personal services business. So if you think about it at a high level, a business generates income from its business structure. So there might be employees, processes, systems, and its goodwill. That's really what generates the income, as opposed to just the work that you're doing. So that's at a high level. And then from a tax law point of view, there's 4 tests, but the main one that I want to focus on as the key is called the results test. So if you are working for a result, so that means I'm contracting with a client or customer, I have to provide this objective or result or product. And this is mostly in a service industry basis. If you're providing goods, that's you should be okay. But if you're working for a result, then it should say in the contract that you have to deliver that. You should have to provide your own tools and equipment to use on the job, and you have to be liable to rectify if you don't deliver or if there's an issue with what you deliver. So that's the key elements of the results test, which shows that you're carrying on a personal service business. And
then the PSI rules don't apply. So that's the results test. Now, what are the other 3 tests? And do you need to pass all 4? Or is it just the results test that you have to pass to get away from that PSI rule?
If you pass the results test, you don't have to consider the other 3. So that's why I call it the key test. It's the key that unlocks the PSB door, if you like.
Yep.
The other 3...
What's a PSB?
Personal services business.
Business, right.
Yeah, business.
Right. So PSI being personal services income. But if you're generating PSI through a PSB, does that mean you're out of the PSI rules?
There might be some income that needs to get paid to you. So if you are an IT expert or consultant, you're still working in the business providing your expertise, right? So you still need to get some remuneration for that PSI. And that's kind of a income splitting analysis, which the ATO brought out a ruling November last year, and it updated a lot of these examples, because the last ruling was 20 years old. The most recent one has all these examples about IT contracting and things like that. And in that ruling, it also says, even if you are satisfy the PSB tests, you still need to think about whether you can income split. So what I mean by that is paying dividends to individuals other than yourself as the main expert in the business, or using a trust structure to pay out distributions. The ATO still hates the idea of income splitting, I think.
Why is that, Jono? Why does the ATO take such a dim view of people out there who might be running an enterprise through another structure, splitting income with a spouse or with a related party? Why is that so offensive to the commissioner?
Well, in their view, you're only doing that to get a tax advantage.
Right.
You're not doing it as a commercial arrangement.
So less money for the government, basically.
Yeah. Yeah. We're kind of seeing that trend of the ATO starting to come out with more rulings saying that we don't like this arrangement, we don't like this arrangement. There's one for professional firms as well that has been released, that's talking all about how much income should a professional firm pay out to non-individuals, so accountants, lawyers, things like that. So it's a general trend. I think they don't like the idea that you can split income and manage a tax rate, even though it's entirely legal and legitimate. But under that ruling, you just need to make sure that what you're doing is commercial, and you're still getting essentially a market value remuneration for what you do in the business.
Yep. And the onus is obviously up to the business owner to prove that as well and show that.
Yeah. Yeah. So having good records, having good accounting systems, getting some written advice on your files, for example, is a way to defend against that and make sure that with your accountant or advisor, you consider that ruling and make sure you're okay with that.
Now, Jono, we got away from it, but you said there are 4 tests. So the first one, the key test to unlock the PSB door is the results test. But if an individual or business can't meet that test, what are the other 3 tests that they could satisfy to then be a PSB?
I won't go into heaps of detail, but just at a high level, there's an employees test. So, if you've got employees producing value within the business, then that's one test you can pass. If you've got a business premises that you have exclusive use of. The other one is you have unrelated clients. You're advertising to the public. Your clients are not related. It's not like you were in an employee relationship and then the next day your employer said, I want you to be a contractor.
Right.
Here's a contract.
And is that unrelated clients test, is that where the standard understood 80-20 rule comes from? And what is the 80-20 rule and how might it apply to you at home?
Yes, the 80-20 rule gets talked about a lot, and that is where, correct me if I'm wrong, and we'll put it in the show notes if I'm wrong, but where 80% of your income comes from one client. So
that's my general understanding of it as well.
Yeah. So if you're in that kind of scenario, then you have to be under that to pass that test. So
hence the unrelated clients test.
Yeah.
So your clients can't all be related and grouped.
Yes.
Because if you have only one primary payer, you're a deemed common law employee.
Yeah.
Or you risk being a deemed common law employee.
Yeah. You look more like an employee or what you're receiving is PSI.
Yeah. The substance of that arrangement then is of an employee versus an actual commercial business. And just for the viewers out there, to be clear, you only need to meet one of the 4 tests?
Yes. Results test, happy days.
Yep.
Or one of the other
3.
and the 80-20.
And before we move on to the next topic, is that a every year sort of scenario where you have to review the arrangement to make sure that you're not caught under the PSI rules?
Yep. Yeah. All these rules are income year by income year.
Got it. Makes sense.
These rules are complex as well. So if you are thinking about setting up your own enterprise in whatever structure, you should seek advice on whether or not it will be effective for what you're seeking to achieve, because these rules are technical and hard to navigate.
Yeah, or if your employer has asked you to, let's make this switch from employee to contractor, definitely speak to your advisor to make sure you get the right advice before you actually go ahead.
And in some cases, Phil, like I've had clients before where they're happy to have income attributed to them from a PSI entity that doesn't meet the PSB tests simply because they want to maintain the contract. But the contract requires that employee to engage the employer in a different form. So it's not that these rules are bad, but you have to know that if they affect you, how they affect you, and will that change your decision on whether or not you go down whatever route you're deciding to go down in generating your income. John, do you have a real life example of where you've worked with a client on a PSI issue?
Yeah, so in the past few months, I've worked with an IT contractor, kind of like a website developer.
That's quite a common one to see.
Yeah, to be more specific, this person had one main client, but what we did was we looked into the contract in detail, and the statement of works that was provided had very specific deliverables of what that person needed to provide through their business, and the contract fee was fixed, even though it was paid regularly. So that was one where we're able to argue in that case, because of the specific deliverables, the results test is met. So in that case, not PSI. And then the second part of how I helped that client was, okay, well, what should the business pay that person? The business, and, we kind of get down to the ATO ruling, and we come up with a number based on industry type, IT, technology industry. What's a market value of someone fulfilling that role? If he was sitting in a company, what would he be getting paid? So that's the second part of the analysis and the work that we did to come up with some ideas and guide the business how much that person should have received as their own income, and the rest is profit of the business.
Yeah, good result in the end.
Yeah.
Okay, so a lot of Aussies invest in the share market, and everyone probably has some sort of holding in CBA or a blue chip stock, Wesfarmers, for example. And what you've probably seen come through your mail is a opportunity to do a DRIP or get into a dividend reinvestment plan. Now, for me as an investor, I see that and I go, okay, well, I'd rather take the dividend, build up my cash reserve, and at a certain point in time, maybe 3-6 months down the track, I will then look to buy shares that are undervalued or buy the same stock at a cheaper price. Chris, could you tell us why someone should or would, or the benefits of getting into a dividend reinvestment plan versus holding cash and looking to purchase stock down the track?
So many of you at home might be thinking the same question as what Phil just asked. And the essence of what Phil has asked is the difference between going after a capital gain or speculating versus with a dividend reinvestment plan, it's simply seeking yield, investing and holding and creaming off the top some part of profit. There's nothing inherently wrong with either of them. There's nothing inherently wrong with what Phil prefers to do, which is more speculative. And there's nothing inherently wrong with what you may choose to do, which is simply buying and holding high yield assets that pay you money regularly, little bits of money over time, rather than a big sugar hit. There's a yield growth spectrum. And every client, every one of you out there will be on a different point in the spectrum, somewhere along it. Everyone's view is valid if they feel that it is right for them. There's no correct way to invest. having said that, Phil has raised an issue that is something close to my heart, because in my own super fund, I have quite a lot of shares that simply pay yield. So they pay dividends over time. And what not only myself, but a lot of my clients also do is dividend reinvest. So when Phil refers to a DRIP, a DRIP, that's kind of accountant speak for a dividend reinvestment plan. And there are big differences between a dividend that comes out of a productive business, like a company that's listed on the ASX, versus an investment that is denominated in dollars or some form of currency. So for example, when you have a dollar, Phil, you can choose to put that into an interest-bearing account or into a interest-bearing instrument like a bond or a corporate debenture that will pay you an interest rate. There's big differences between doing either the interest-bearing deposit or putting that same dollar into a share in Woolworths. And that is what I'll explain here. I'll focus on the 7 elements of a reinvested dividend that would count as income and explain why it's tax efficient.
You're talking about difference between equity versus debt, really?
So what I would say, Jono, is that if you hold a share in a company, just to keep it simple, we sometimes refer to that as equity. It is an equity interest in a company, and that really is just a share. So you can log on to CommSec or whoever your broker is and buy shares in a whole heap of companies listed on the ASX whenever you want. Then you can also hold that same dollar that you could have put into a share into an income producing asset for you that's based on interest. So it's denominated in a currency. Yeah. So it could be referred to as a debt interest. But really it's just, for the people at home, just think about it as putting money into a savings account versus putting money into a share listed on the ASX.
Yeah, which is like the difference between the bank owing you and you owning some ownership of the bank.
Correct. So the first element of a reinvested dividend that is income, by far the easiest one to understand and where most people would stop, is the cash component of that dividend. So if you hold 1,000 shares in a company and the directors declare a $1 dividend, you will get paid one way or another $1,000 in cash. Everybody understands that. It's fairly simple. The second element of a reinvested dividend that is income, but that is a little bit harder to understand, is the franking credit that's attached to that dividend. So in Australia, we have the imputation system, which allows a company to carve off a chunk of the tax that it has paid on its own profits and give that to the shareholder or impute it to a shareholder. To summarize the effect of the imputation system, what it means is that if you receive a dividend that is franked, you only have to pay the top-up tax between the rate of the franking credit and your personal marginal tax rate on that dividend. You don't have to pay the whole amount because, like I said, part of the tax that has been paid already is effectively given to you. So the ATO knows that that dividend has already had 30% of its tax paid on it.
Yeah, and in some cases, depending on the individual, you may get a refund.
Absolutely. So if your marginal rate is above 30%, you will have to pay the top-up tax to your marginal rate. Say your marginal effective rate is 40%, you'll have to pay another 10 cents on top of the dividend in tax. But if your effective marginal rate is at 20%, then as Phil correctly said, you'll get a refund of the excess franking credit, which has been imputed to you at 30%.
So that's 2. What's the next 5?
Yes. So the next part is what's called retained earnings or look-through earnings. So when a company pays a dividend, they'll use what's called a payout ratio. If a company declares a dividend of $1, it may be the case that the cash profit per share is actually $1.50, but they won't pay out 100% of the profit. They'll only pay out the $1. So they'll retain that 50 cents and reinvest it into better people, better systems, better advertising. What is happening with that 50 cents is that they're expanding the company is expanding what is referred to as a strategic moat to increase its competitive advantage over time.
Yep.
So if you're a continuing dividend reinvestor, you're not only getting the $1, you're not only getting the franking credits, you're also getting the benefit of reinvestment internally inside the company of the earnings that are retained, which will increase the earning power, hopefully, of the company into the future.
Makes sense.
Yep. So you're saying over time you're getting more ownership in that company, right?
The theory is, Jono, that you're getting more ownership in a better asset that's strategically superior to what it was in the past because it's reinvested the retained component of the profits into better systems and staff, people.
Yep.
So the fourth element in a dividend reinvestment plan, the fourth element of income is brokerage-free allotment. So typically, with any big company listed on the ASX, if you participate in the dividend reinvestment plan, the company will allot shares to you without you or your super fund or whatever entity is doing the investment having to pay brokerage on those new shares. Now, that doesn't sound like much at the start, but the bigger your shareholding and the bigger the cash components of your dividends become, the more beneficial it is to not have to pay brokerage fees when acquiring new shares. Now, that benefit is not subject to income tax.
Which is good.
Which is very good.
Which is another added benefit.
Yeah. It's like a cost saving.
Absolutely.
Yep.
Or the next income component, the fifth one of participating in a dividend reinvestment plan is treasury concentration. So what will often happen is that the treasury departments of big companies that are listed on the ASX, they will always retain some of their own stock to satisfy the roughly 10% of shareholders who fully participate in the dividend reinvestment plan. What that means is that as you acquire more stock and as the company has to acquire more stock to transfer more shares to you to satisfy your participation in the DRIP, effectively what is occurring is that the company is using its own cash, part of which is yours, which is retained, that's true, to buy more of its own stock on market to satisfy the participation in the dividend reinvestment plan. Effectively, this is reducing the number of slices that the pie is cut into. So each slice that you retain is proportionately worth a little bit more money every time that a dividend is declared.
It's a tricky one to understand, but basically I think you're saying when you're reinvesting, they're not issuing new shares, they're not handing out more shares, which would bring down the value of all the other shareholders.
Correct. They're not cutting the pie into more pieces generally, although they may. In some cases, they may. So the trick is you actually have to read the annual reports to see what the companies are doing. ANZ is a good example of one where they satisfy the dividend reinvestment plan by directing their guys in treasury to hold enough shares in their own bank to transfer across to the participants. Okay, that is a benefit to the continuing shareholder. Okay, because like you said, it's not the investee issuing more shares to satisfy the DRIP, which is carving the pie into more slices, which reduces, that's a good word.
Yep.
It's not diluting the value of the share. It's actually concentrating it because the company's own cash, of which you own a chunk of, is being used to buy its own equity on market and transfer those shares to you because you're a continuing participant in the DRIP.
Yep. Makes sense.
And is it mostly, we've been mentioning banks, big banks in Australia, but are there other sorts of companies or industries that would offer this?
Absolutely. So the key is to look at the annual reports of the companies and then also just type into Google dividend reinvestment plan for whatever company you're planning on investing in.
Yep.
And you'll find that many of them have active DRIPs. So the sixth income component of a reinvested dividend is the gain on reinvestment. And what that means is that when you reinvest your dividends back into the same company that you intend to continually hold, the way that the reinvestment price is set generally is called the WAM, or the weighted average market price of a share over a certain period in between when the dividend is declared and when it is paid. So that might be a week where the share price is relatively low, for example. So in that week, the directors will look at the closing price of the share on each day, and it may be on average $5 over the course of a week. Then when you get to the point where the dividend is actually paid, which is the same date as the allotment date for the shares under the dividend reinvestment plan, the price of that share may have spiked to $7. So you're getting awarded shares that cost you $5, where their market value at the point in time of allotment is actually $7. So that means that you have made a non-taxed gain of $2 per share on paper.
Yep.
Yep.
So you're getting a slight discount on the...
That's right, a non-taxable discount. Now, the reverse can also happen. So you might have a situation where the weighted average market value is $5, but on allotment date, the price of the shares has gone down to $4. Generally, that won't matter if you're investing for the long term, which generally a dividend reinvestor would be doing, because we're dealing with companies that are mature businesses and where the price will undulate but will go up over time. For example, the banks or the supermarkets are a good example.
Yep. Is there one more, Bloxy?
Last one.
There is more, but wait, there's more. So the final income component of a reinvested dividend is what could simply, in its most simple form, could be referred to as slice merging or capital management. So this one isn't specifically related to dividend reinvestment. It's more related to long-term shareholders. So what can sometimes happen is that every now and then a board, for example, the NAB in 2020 throughout to 2022, spent about $5 billion of its own cash simply buying back shares on the market and cancelling those shares. So where you have a pie and the pie is the same size, but it's been cut into smaller pieces because some of those pieces have been merged, then the pieces that remain are more valuable because they're bigger.
Yep. So you're saying it's like the opposite of the issuing of more shares. Issuing more shares is cutting the pie up into more pieces, making those pieces less valuable. This is the opposite. Buying back shares and cancelling them is making the remaining shares more valuable.
Absolutely. And a good way to see this is to, if you have a share broking account at home, click on the NAB and go to its announcements. So when the board of directors has told the treasury guys inside the bank, you need to buy back $5 billion worth of shares, that's called a capital management program. And they have to announce that to the market. It's market sensitive. And they have to declare how many shares they've bought on which day and what they did with them. So, for example, NAB is one, but plenty of companies do it, where if you look at the NAB's announcements over the past couple of years, which everybody can do, it's publicly available information, you'll see how many shares they are buying daily on the market and what they've done with them, which is simply cancel those shares. Now that concentrates, which is the opposite of dilution. So those who continue to hold and reinvest in those shares will become wealthier just by virtue of the fact that the company's cash is being used to cancel its own listed equity.
Yeah, the last couple are a bit technical. Maybe for the viewers out there, you may not understand it, but I think there is an article that you've written, Bloxy, on our website.
There is an article that I've written on this in the blog, and we will put a link to it in the description.
Yeah.
And we may just flash it on screen now as well for the viewers at home to see. If you are at all interested in it or want to learn more about it, feel free to reach out to either your accountant or to ourselves.
That was the 7 income elements of
a reinvested dividend.
Yeah. And I know you said there was more. So I guess, if you're wanting to find out, viewers out there, the 8th or the 9th income element, give Bloxy a call because it's a secret.
And book an hour-long meeting.
We're not going to reveal that on the podcast today, but if you want the 8th and 9th, speak to Bloxy. But no, that was really good. And obviously what people don't see is the power of compounding. So if you are in a drip and you start now, the power of compounding will happen over time, and that's just going to increase the value of your assets or the shares that you hold a lot.
Yeah, absolutely, Phil. Like compounding is tax-efficient compounding in Australia really can't be understood without understanding the tax implications of dividend reinvestment programs in our big companies. It's very important for people to understand that. And it's not just a super situation. That you can hold shares personally, you can hold them through a trust, you can hold them in a number of ways. So it's important for everybody to understand dividend imputation and dividend reinvestment.
Makes sense. Okay, last question. So if you're wanting to do a DRIP, what would you say is the best vehicle? Do I do it under my own personal name, under my family trust, under a company, under a self-managed super fund?
Obviously, given the concessional tax rate, a self-managed super fund is probably the most tax efficient way to do it for most of you out there, but it's not the only way to do it. It shouldn't preclude people who want to tax efficiently compound from doing it personally.
But what would you say is the biggest benefit of doing it in an SMSF?
So inside a SMRF, inside an SMSF, you will get what's called franking credit arbitrage because the credits are imputed at 30%, whereas a maximum tax rate inside the fund is 15% for investment earnings. There's a slight caveat that I would put on that, which is that if you are approaching or nearing the $3 million balance limit inside your superannuation account, it's getting a little bit trickier to say that in all circumstances, holding more and more assets inside your super account is the smartest way to go, because there is, as was mentioned in our previous podcast, a measure that's on the table now by the current Labor government to tax unrealised gains in super funds above the $3 million account balance, which is dangerous because it's non-cash income that may cause you to have to pay a lot more tax than you otherwise would want to. But that's been discussed in a previous podcast.
Yeah, tax on unrealised gain, that's something we don't want.
So you have to have different conversations with a client who is approaching that limit about where they're going to continue to invest in, what vehicles they're going to continue to invest through.
Yep, 100%.
Makes sense. All right, folks, that's all we have time for today on today's episode. Thank you again for joining us. And if you learned something here, share this episode with someone you know. Until next time.